This is the really uncomfortable new reality for investors in 2020. Rather than looking through financial reports or calculating a company's free cash flows into perpetuity, the key to being a successful investor in 2021 has been investing in things based on their proximity to Elon Musk. This is what's called the Elon Markets Hypothesis, which I like to call the Elonomy. From Bitcoin to Dogecoin to more recently Hertz in their 200,000 car Tesla order, or silly meme NFTs or Shiba Inu, there's been a frustratingly large amount of return on invested capital if you were, depending on how you look at it, smart enough or foolish enough to invest along these lines this year. At the same time, more traditional, or as some would say, educated or experienced or wise or talented investors who spend their time trying to optimally balance their portfolio by weighing risks, future outlooks, and spending hours analyzing endless financial statements and charts come to a coherent valuation are starting to feel pretty stupid. As investors looking to build real wealth for ourselves, to pay off debt or break into fire financially independent, retired early, or simply live a life of freedom and flexibility, there's a lot to consider, and frankly, it's getting pretty overwhelming, and I think a lot of people are pretty frustrated. In this video, I wanted to take a look at what exactly might be going on, why it's degraded to this level, and how we might be able to adapt our investing styles going forward. Now, I know as a primarily finance and entrepreneurship YouTuber, my job is to simultaneously entertain you while providing tidbits of information that might be able to help you along your journey to reaching your investing goals. But the very concept that there are literally hundreds of finance-based YouTubers is, while absurd, also an indication of the rate of change that's happening in the world of investing right now. Even like 15 years ago, this entire concept wouldn't have existed, let alone people being interested in listening to what I would have to say as someone who isn't a talking head on a big broadcast network or somebody like Warren Buffett. In a video I did a couple of days ago, I broke down what has strangely evolved into my top 10 holdings lately, and it was fascinating seeing the responses I got from people. I think a lot of people have looked at me primarily as a value investor or primarily as a growth investor, but a lot of you surely look at me now primarily as a meme investor too. Though I didn't start out with investing massive amounts of money in Tesla or Bitcoin, those investments have blossomed into being the leaders of my portfolio, basically, prompting comments like, "Wow, I didn't know you only invested in memes, noob." And so the question we're all starting to ask ourselves is, what is the best way to invest in this new Elonomy? Traditionally, we've been told that we can optimize our investments based on our risk profile, our income, our expenses, our goals for investing, and a number of other factors. And there are a lot of you guys who really love my videos on companies like Nokia, Nordstrom's, AMD, stocks that under traditional value investing rules should have a higher share price. And fortunately, I've done splendidly on all of those stocks. But the problem is that I've done way better on a few of the other holdings I mentioned in that video a couple days ago. I didn't talk about many of the cost bases or how much I put into them, or how much each position has multiplied. And by all measures, you can't really sit down and calculate the precise number of solar panels or Model Ys Tesla is going to sell over the next 10 years and say with any measure of certainty that, yes, this company will be worth precisely $1,432 per share and will split 2-to-1 3 more times by 2031. And so traditional investors who prioritize like a low PE ratio and well-managed debt loads scoff at Tesla's current valuation already, let alone the $5,000 per share prophecies made by some across the interwebs. Dude, and Bitcoin is even more absurd when it comes to any attempt at credible valuation. Though there are absolute geniuses behind many cryptos, a simple Google search will reveal that in the vast majority of cases, there are entire armies of people who make a living just shilling their favorite cryptocurrencies. So while many of us have resorted to endlessly scrolling up on Twitter to be the first one to see Musk's next investment to jump on board, I wanted to take a step back and zoom out. Flocky Inu can wait for a few minutes. The last few years have been tremendously complex for everyone, and it's not just because of the pandemic. It's not just because there's a new administration running the show in the US, and it's not just JPal's infinity money hacks. Let's zoom back even more and play with some ideas. As a Canadian American who's been living here in Japan for more than 10 years, I'm really interested to hear your thoughts on this, and I would love to start a conversation down in the comments section. What do you think about and how do you feel when you see this guy? There's bound to be a handful of people watching who are immediately uncomfortable or angry or even triggered. And there's also a handful of people who are probably pretty happy or pumped up by seeing Trump. But I'd be willing to bet that there aren't a lot of you who are just like, oh yeah, that guy, what's his name? Yeah, he's cool. I wouldn't mind having him over for a beer or whatever. Now, love him or hate him, one of the things we all need to realize about Trump is that he's a genius when it comes to marketing. You know how I know that? Because you have those polarizing emotional responses. Most people weren't expecting him to win the election versus Clinton, but when he did win, the world kind of started to realize that there was this huge silent majority of people who liked and agreed with what he stood for. Now, when you look at this logo, what do you think about? I don't think people will be quite as polarized, but I'm willing to bet that most of you will fall into one of two camps. One saying, I love this company and I love their products, and the other one saying, I hate that company, I'll never bow down, I'll never enter their ecosystem. And there just aren't a lot of people who are just like, yeah, whatever, Apple's cool, but so is Microsoft and Google, they're all dope. And it's because Apple also understands that sales and success are connected to emotions. One of the things we're taught in marketing is that you need to strongly appeal to some people, and therefore you need to strongly turn off many other people. And Apple gets that, Trump gets that, and you can probably easily list off a number of other polarizing companies you either love or hate. While Trump was known for being a big-time Twitter user, we've seen in general smartphone and app usage, digital payment usage, and all kinds of other new technologies are starting to blossom before our eyes in this generation. And along with that, traditional methods of information dissemination, like physical newspapers, have been getting kidney punched. Check out this slide from wikibon.com that shows how massively print revenues have plummeted since we got into the 2010s. And while the unidirectional flow of information collapses, the methods of dissemination, such as sharing articles on social media, to discussing with thousands of strangers on Reddit, to forming online communities around shared interests or pursuits or hobbies, has started to bloom as well. Now check out this slide that shows us how tremendously, particularly print advertising revenues as a percent of GDP, are falling off a cliff in response to digital means. And you know what all this means? For newspapers and other traditional media sources to survive, they're having to learn how to make money in new ways. In the same way I make money whenever a commercial appears on my YouTube videos, these massive newspaper companies are now needing to count views and clicks and watch time to appeal to their advertisers. And you know how you get clicks? Same way Trump or Apple do. They hit you in the emotions. Then you share on social media with your friends or people with the same hobbies, or I guess even your enemies. And so in a very real way, your attention, your clicks, your thumbs up, your shares are one of the new currencies. Keep that in mind and let that be the lens that you look through for the rest of this discussion. So next, let's zoom back in. International pandemic paralyzes the world, causing international traffic, supply chains, and economies to slow down. So various governments respond in various ways, but the US largely starts printing endlessly under JPOW and the Fed. What do you get when you have a massive chunk of the population now not having to work while receiving money from the government in many cases, while looking for something entertaining or enriching to do with all of their free time, and combine that with brand new means of instant access to information like Twitter or Reddit or whatever, and really easy to use apps that almost gamify investing like Robinhood, all into one blob. The inevitable result is that you see a wave of new investors thirsty for direction and education, many of whom are more tuned into the meta of what's happening around the world, and many of whom are also unconscious of this new lens that we mentioned earlier. This CNBC Momentum Invest in You survey shows 26% of the general public began investing in 2020. In fact, 60% of young investors first started investing in 2020 or later. Now, shows like Cramer's Mad Money are often considered dubious scams by long-term investors, but many of us have wondered, like, how influential are his ideas actually in influencing the market? Now, it's hard to say whether or not he's telling people to buy into stocks right after he has, or if he's getting people to pump so he can dump. But this guy on Reddit named Knobjoss analyzed 725 of his recommendations made in 2021. Simply put, and there were limitations to the analysis, of course, but as he mentions, the conclusion was that the one-day returns, just 24-hour returns, on both his buys and sells were amazing. As you can see there, 555%. Some of that is probably people responding to his picks, responding to what he says, and then making a move, causing the price to move in the prophesied direction, I guess you would say. And if that happens with enough people, enough times, then the price is going to move drastically, right? And when enough people share enough sentiment on a stock or the market as a whole, we can see the situation changing in a really big way. The GameStop phenomena was another example of this. And speaking of the GameStop example, which I actually made a couple of raps about, trying to fit as much information as I could into a 1-minute short. Click up here if you want to check them out. There was this heavy underpinning of basically mistrust of the big money and the media in general that we started to see forming, especially in the Reddit communities. In fact, rather than being, hey, let's make some money on this, it seemed the majority of discussion at the time was, we need to screw those big money hedge funds because the system is broken. The battle still continues on today, with GameStop very much not out of business, as the original funds shorting it hoped they would be. So now we have these dynamics of a new huge base of investors with money on hand looking for trustworthy leadership and investing advice away from the typical sources of news or information, and then slather on a nice thick layer of, we share information because we feel emotionally attached to that outcome. And it sets up the scene perfectly for the ultimate meme lord and environmental superhero, Elon Musk. He's always been against the establishment, and all of his companies show that. He doesn't care if General Motors employees are going to lose their jobs. He cares about actually forcing the industry to make moves huge enough to alter the trajectory of global warming, right? SpaceX has basically been designed to make clear how inefficient and absurd NASA has been, and is now putting them to shame with industry-breaking prices for satellite launches. Like, it's actually broken how huge that price gap is. And rather than never going to the moon ever again, he's freaking aiming for Mars. And there's your man for this new generation. He stands up against the establishment, but he wins. All while being a stuttering nerd who's kind of like not actually very good on stage. And while most of us can't relate to him in mental capacity, we can all relate to his genuine desire to make the world a better place. So that's the why for how this Elonomy has started up. Now, what do those of us who've been frustrated by these trends do to keep our portfolio growing? Should we just drop our slow growth dividend portfolios and YOLO on Shiba Inu? I'm super duper curious to hear what you guys think. So seriously, please leave a comment down in the comment section. And like I mentioned in my last video, I'm trying to adjust. I'm trying to evolve. I'm trying to get better at being more flexible. I don't think having Bitcoin and Tesla as my largest holdings is necessarily safe. But when I multiply my money by 10x on an investment, I only need to sell 10% of my position to now have a cost basis of free, along with the potential for massive continued growth going forward. Personally speaking, for my own portfolio, I'm not going to be making any like massive dramatic changes immediately. My long-term slow growth, no load S&P index has been doing just fine, and I'll continue to auto contribute to that as I have for the last 10 years or whatever it is. But I'm trying to start like micro adjusting, you know, so I can start capitalizing a little bit more on a lot of these new trends. And I like getting that 5 to 10% return per year from that portion of my money. That provides a lot of solidity. But I struggle a lot because the old way has become so ingrained in me, you know, how to analyze a company to find out if it's a growth or a value investment, or playing around with the variables to see if my upside is 10 or 20 or 30% over what horizon. Like, I'm kind of wired and experienced to be looking at everything like that. At the same time, part of me is also okay with how the world is changing too. Dude, I like being able to access information immediately anywhere I am, using invisible waves that fly through the air. And I like the various online investing communities like Reddit, where pros and noobs can get together and share ideas or even personal experiences from working inside that particular company you're looking at. This is all new stuff that the vast majority of us didn't have access to even like 5 years ago. On the other hand, I'm not a huge fan of, you know, hashtag fake news and every single news headline being so emotionally triggering that a 30-minute broadcast leaves me with PTSD. I wish news and media and social media was the same as it was before it got so inflammatory, but I also understand that things had to go this way and probably will continue to go this way. So it's going to be important to keep my roots planted and keep my wits about me, while at the same time having my head up in the air, you know, having my antenna out. Stay on top of the meta. Stay on top of the headlines. Stay on top of what the media is wanting you to think. Stay on top of what's trending on Wall Street Bets or Reddit or Twitter. These will give you clues to what may be happening. For me, living in Japan, I love sleep too much to be online while Wall Street is open. And I can't be day trading. Dude, and recently we found out that we have twins on the way, which will probably make it even harder to care about what's happening with stocks overnight. So I'm learning how to leverage my research and investing time throughout the day when I'm awake. And I'm trying to get the right balance of risk versus reward. But I'm also trying to learn how to be a bit more open to things not working in the traditional way they always have. I'm going to keep analyzing my favorite stocks, but I might also need to be brave and try putting some money into things that make my current ratio loving ass a bit uncomfortable. Now, a lot of people are sure that once the next big crash or even a slight downturn hits, it'll shake out all the noobs, all the paper-handed beginners, and yes, I'm sure there are going to be loads of people who end up getting wrecked because they have zero concept of risk management, diversification, asset allocation, or things like that. But I also feel like we're seeing a generation that has less to lose and therefore is more comfortable with risk than America has seen maybe ever. Check out this chart. It shows millennials down there on the bottom in the yellow. They don't have a lot, dude. They kind of have to. Now, we know that past returns are not an indicator of future results, so we know that we need to be open to things changing more and more rapidly as we go. Are the good days behind us? Or are they just around the corner? Love you guys, and don't forget to stay generous.